In this video, I'm going to talk about how to account for an employee share purchase plan. With an employee share purchase plan, employees can buy shares of stock directly from the company they're working for. They don't have to pay any brokerage fees, and the employer might offer them a discount or offer to match or partially match any purchases of stock that the employee makes. Now, the accounting for an employee share purchase plan depends on whether the plan is considered to be a compensatory plan or a non-compensatory plan. For it to be a non-compensatory plan, 3 conditions need to be met. First, substantially all the company's employees must be able to participate in the plan. Second, employees can't have longer than 1 month after the price of the shares would be fixed to decide whether they want to buy those shares. And third, the discount that's offered to the employees to buy the shares can't be greater than 5%. Now, if these 3 conditions are not met, the plan is considered to be a compensatory plan, and it's accounted for like other share-based compensation plans. And in that case, what we mean is that the company will have to record compensation expense. So if you don't have all 3 of these conditions met, it's a compensatory plan, and the company's journal entry that they would make when employees, for example, buy shares from the employee share purchase plan, the company would debit cash for the cash received. It would debit compensation expense for the difference between the market value of the shares and the cash received from the employee. So this is basically the amount of the discount will be compensation expense. And then assuming that the shares had a par value, the company would credit additional paid-in capital and then credit common stock for the par value. Now, if the plan is considered to be non-compensatory, you have the same journal entry, except you are not going to record compensation expense. So that's the difference of compensatory and non-compensatory, whether or not compensation expense is going to be recorded. So let's do an example. Let's take a company that makes umbrellas for people's phones. What a nifty device. Yeah, that's really needed in our society. So phone umbrellas allows employees to purchase common shares of stock directly from the company. Those shares have a $1 par value per share. And let's say that the company will give the employees a 15% discount relative to what the current market price of the shares happens to be. So basically, whatever the market, so let's say the market price is $80 per share, the employees would not actually have to pay $80. They would only have to pay 85%, which is 100% minus 15%. They'd pay 85% of the $80 share price, and then basically the remaining amount is the discount that the company is going to record as compensation expense, because we've got a 15% discount. It's higher than that 5% I mentioned for a non-compensatory plan. Okay, so we got a market price of $80 a share. Let's say the employees buy 10 shares. Okay, so now what journal entry would this company have to record? So as I said, this is going to be treated as a compensatory plan. The reason being we have a 15% discount, which exceeds that 5% threshold that I mentioned earlier. So we're going to debit cash for the amount of cash received by the company. Now remember, you might think, well, but the market price is $80 a share, 10 shares. Normally, so if the employees were just buying those shares on the open market, they'd pay $800. But they're getting a 15% discount. Okay, so they're getting a $120 discount. So they don't have to pay $800. They're paying $680. Okay, so 15% of the $800, that's a $120 discount. So the employee, now if we take the $800 and you subtract that $120, you get the $680. Or you could take 85% times 80 times 10 to get to the $680. Either way, the employees are actually paying $680, so that's the amount of cash received by the company. And then the discount is going to be recognized as compensation expense by the company. Now, we are going to credit common stock for the par value of the shares, which is $1 par per share times 10 shares. So we've got a credit to common stock of $10. Now, you could figure out additional paid-in capital in a couple ways. Number one is if you didn't know what this was, you could say, okay, we have $800 of debits, $10 of credits, so there must be a credit to additional paid-in capital of $790. Alternatively, you could say, okay, $80 market price times 10 shares minus the amount that's recognized for the par value, 10 shares times $1 par value per share, and we end up with the credit additional paid-in capital of $790. Now, hypothetically,
If this was a compensatory plan, so the company had to record compensation expense, but if this was a non-compensatory plan, then in that scenario, again, the company would not be debiting compensation expense. They would just debit cash for the amount of cash received and then credit common stock and additional paid-in capital accordingly.